right, so portfolio overview for the week. So as of October 8th, my total equity with Questrade is sitting at 102,097. So got a total US cash of 1634 in my margin account, 0 Canadian. And the only position I have is that naked put that I keep rolling on Rocket. Nothing has changed. I still have it until November 20th. If I see it drop below $2, if I see it drop below $1, I'll probably close it instead of waiting till November 20th, which is 42 days away. In my TFSA, I've got 520 Canadian cash and I've got 34K US cash. And the positions are basically some dividend stocks. So Bell, and they're each $1,000 worth. So Bell, Bank of Nova Scotia, China Mobile, Choice Properties, Gold, Manulife, Pizza, Ryokan, AT&T, and TD. I think TD pays about 5%, AT&T about 6%. Ryokan, I don't remember, let's check. I think it was a good one, 10%. I don't know if it's sustainable, but right now it's paying 10%. And I think Pizza is about 6%. So 7%, okay, good. Manulife I think is about 6% as well. Manulife.to, 5.75. Gold doesn't pay any dividends. Choice Properties, let's go see. I don't remember. I think it's over 5%. Yeah, 5.83. And China Mobile, I think China Mobile is twice a year dividend, but it pays about 5.78% dividend per year. Bank of Nova Scotia is around 5%, and Bell as well, I think, is around 5%, 6% right now. Okay, good. In my RSP, I've got 1,300 cash Canadian and 8,000 US. Right now, I only have two positions. They're both covered calls. I rolled them today, actually. So I've got IWM, which is the ETF that tracks the Russell 2000. So I've got an average cost of 151.6. It's trading at 162. So I've got a profit of 1,100 on the shares, but I can't take advantage of those gains because I've got a covered call against it at a 152 strike. So my max selling price on this trade is basically my short call, which is the 152 strike. But in return, I keep selling premiums. I keep collecting premiums. So under orders executed IWM, these are all the premiums that I'm collecting. $1. So today I collected $1. Last week $1. The week before 42 cents. So this is times 100. $90, $100, $125, $110, $58, $100. So probably since February I collected maybe a little bit over maybe 2,300 US in premiums. Now IWM just recently reached 162. Last week it was trading below my cost. So last week I looked good selling all these premiums. Now this week maybe not so much because the shares itself is showing 1,100 profit, but I'm okay with that. My goal is to extract as much premiums as possible from this position. And Virgin Galactic, I rolled the call. I went to November 20th at a 23 strike. My cost is 23.62. So if I lose my shares at 23, I'm going to lose 62 cents. But I don't care because I've been collecting enough premiums to compensate for that 62 cents. So if I go to orders executed, SPCE. So today I collected $2 to go all the way out to November 20th. And so $200, $40, $65, $30, and $100 from the first time. So enough premiums to make it interesting. So that's what I'm doing with my RSP right now. I'm looking to do obviously more covered calls, but I feel like I need to pick the right stock and also have the right timing because I don't want to end up with a stock that drops 30% on me after I buy it, which seems to happen a lot with my covered call trades. So in my RESP, I don't have that much cash. I've got 95 and 178 USD. So the US cash actually increased, and that's because I sold premium. I rolled my covered call on Intel, so I went from 56 to 55. I dropped, but I collected some premiums, and I'll just keep rolling the call option if Intel does happen to trade above 55 come November 20th. So I collected $100 today. Last time $63, $30, $27, $24, $86, and $100 the first time. So in my margin account, I'm going to continue doing credit spreads. I'd like to get into naked puts, but I still don't have a plan to mitigate in case the trade goes against me. I don't know if I could. I know that you can roll for a credit forever, but I don't know if it's the right strategy, if it's the right approach. Because what if you sell a naked put on Tesla, let's say at 400 strike, but then Tesla decides to fall to 300 or 200. Yes, you can roll, but your buying power is going to get reduced by more than 50%. You're not going to be collecting as good premiums, and you don't know how long you'll be rolling for. So for example, let's look up Tesla. So if I wanted, I could have sold a naked put on Tesla, let's say for next week, right? For October 16. So the 430 strike gives me $10, so that's $1,000. Obviously it's too high. Let's go a bit further away from the current market price. So let's go to 380, 390. What seems safe? 400. Let's try 400. So 400 would get me $2. I don't think that's worth it. But let's just see how much capital requirement is there. So if I sold the 400 strike to collect $196 or $184, capital requirement right now is $14,000. But if Tesla drops, that capital requirement is going to increase on me while I'm in the trade. At the same time, compared to credit spreads, $200 versus $200 on 15K is not as good of a return on capital as $80 on $400 when I do a credit spread. But let's say Tesla ends up dropping to 300. So to simulate that, let's say I had initially started with a 500 strike and then Tesla dropped to 434. So this week I'd be buying back my 500 put that's completely in the money, and I'd be selling the same strike for next week. And as you could see, I'd be collecting a very small credit, probably around 20 cents or $20, while this trade is probably using maybe almost $20,000 of capital. So in a scenario like this, yes, I could keep rolling for credit and waiting for Tesla to come back up. But while I'm waiting, it kind of sucks because I'm collecting very little premium and using a lot of capital. So that's my issue with rolling puts. If I were to sell naked puts, then maybe I would have to just take the loss if my short strike gets breached and then start fresh the following week. So that's my concern with naked puts, is that I'm not too sure what's the best approach to manage. So for now, I'm going to continue with credit spreads in my margin account. In my TFSA, I'm going to continue with the mixture of dividend stocks at a bargain, or even general stocks that drop at a bargain. And I'm also considering covered calls. I'm even thinking of selling a covered call 1 year out. So for example, if my return or if my goal is to make 15 to 20% per year, I could do that with a covered call if I sell it for a year. I definitely miss out on capital appreciation. So it's like a GIC. For example, let's look at Facebook, for example. So let's say I sell a covered call on Facebook 1 year out. So that would be around September 2021. So there's no September. So let's say I go to January 2022. So if I sell Facebook covered call at a 260 strike, it would cost me about $212 to get in. So what that means is I'm going to buy the stock at 264, but I'm going to collect almost $40 of premiums, which is $4,000. Here, let's look at the calls and puts instead. So at 260, I'd be collecting around $53 of premium, $5,300 for one contract till January 1st, 2022. But what that does is that gives me a potential return of, if I go back to my covered call section, 260 divided by 212. So 260 divided by 212 is 22%. So for me to actually confirm this 22%, as long as Facebook stays above 260 or is trading above 260 come January 21st, 2022, then basically I've confirmed my 22%. I get my capital back. But I actually get the premium right now. As soon as I sell the covered call, I get the premium right away. So the cash is in the account. I'm actually going to get $5,300 deposited in my account as soon as I sell this covered call. And with that $5,300, I could actually use it to do a covered call on another stock for 1 year out. I see it as a GIC because when you buy a GIC, your capital is stuck for a year or 2 years or 3 years, and you're getting interest of 1%, 2% max. And then after 3 years, the capital was released. I could see it the same way as my capital is stuck in Facebook for a year or until January 21st, 2022. And as long as Facebook is above 260, I get my capital back at 260. But in return, I got 22% for doing that. So there is a risk that Facebook is not above 260, but that's why I'm getting a much bigger return, and I'm actually getting the money up front. So I'm getting that premium right away, and I just have to wait a year to get my capital back. So that's something I'm considering in my TFSA. It could be a Visa stock, something that's safer. Obviously, if it's safer, then the premium will be less, but let's look at a Visa covered call for September. So exactly 1 year out at the money covered call. So 206 or 205, let's say. So 205 divided by 183. What kind of return does that give me? So 205 divided by 183. That's 12%. So I could get 12% for the year confirmed upfront, and basically I just wait for September 2021 to get my capital back, as long as Visa is trading above 205. Could do it on JP Morgan, which pays dividends as well. JP Morgan, I believe, pays about 3.6% right now. But if I do a covered call on JPM 1 year out, that's September 2021, and I could go with the 100 strike, so 100 divided by, it would cost me about 88, so 100 divided by 88, that's a 13% return, plus the 3% of dividends that I'll be collecting for the year. That's something that I'm considering if my goal is to make 15 to 20% per year on my capital. And what's good about it is that I get the premiums up front, so I get that money and I could use it right away. So for example, if I've got about, what's my total buying power? So I've got a 45k Canadian total buying power. If I use it and put it in a covered call trade that gives me 15% up front, well, 15% of 45k is going to be deposited in my account. Let's say I'm able to use find stocks where if I do 100 shares of, I'm able to use the full 45k. Well, I'm getting an extra 6,750 that'll be deposited right away, which I can probably use towards one stock or two more stocks. I could, for example, do it on work. Work is 3,100, so I could afford 200 shares of work, for example, with the premiums that I'll be collecting from the initial covered call trades. And let's see, work 1 year out, what can it give me? So there's no September, so let's say I go to January. So work at a 32 strike, let's say 32 divided by 24, I'd get a return of, I think, 25%, 33%. So yeah, so I'd get a 33% return with work. So I'd get the premium up front, which is basically 32 minus the 23.95, the difference. And I get my capital back January 21st, 2022, as long as work is above 32. So pretty simple. Now what happens if work is not above 32? Well, then wherever it is, I will hold shares at that price. And if I want, I can do it again. I could sell a covered call trade 1 year out, hopefully to make at least 15%, if my goal is to make 15% per year. Now, I know definitely it is better to do it on a monthly basis or even on a weekly basis. Problem is, going in on a weekly basis, sometimes the first week is good, but then the second week is bad because the stock dropped. You can't collect decent premiums on your second week or the third week. For example, with Virgin Galactic, the first week I collected $1.50. But the second week, because the stock dropped to 20, I was only able to collect 30 cents. And I actually went 2 weeks out. So the first week I collected $1.50 the first week, and then the second time I collected 30 cents for 2 weeks, and then 65 cents almost for 1 month, and then 40 cents for probably 2 or 3 weeks, and then $2 to go over a month. But that's because Virgin Galactic came back up, so I was able to collect a bit more this time. So to avoid the inconsistency of the premiums every week or every month, selling 1 year would confirm a certain return, definitely much lower than if I was able to sell every week or every month. But that's the trade-off. You're getting something more upfront, so it's more guaranteed, so the return on capital is going to be smaller. But I'm assuming that this is my goal. My goal is 15% per year. I'd be happy with that. And as long as I use a stock that I'm very confident that in a year's time will be above that strike, then why not? But it's something I'm thinking about. I haven't decided yet, but definitely open to feedback. Leave in the comment section below. And I used to own Square at $65. I was doing covered calls on Square. Look where it is right now, $187 Unbelievable. So another potential trade, covered call trade, would be Apple for a year. Let's see what that gives us. So if we look at Apple 1 year out, covered call, let's see, does it have September? Yeah, September 2021. So it's trading at 117. So 117.5 is right here divided by 100. So 117 divided by 100 gives me a return of about 17%. So that's pretty good as well. 17% in 1 year if that's what I want. And then in a year's time, as long as Apple's above 117.5, I get my capital back and premiums are confirmed. The premiums I get right away, but my capital, I can release my capital, my shares, at expiry as long as the stock is above 117.5. And sometimes if the stock rallies a lot, I could probably get out of the trade before expiry. So if the stock goes to 200, for example, I most likely don't have to wait till September 2021 to release the capital. I've already collected the premiums. I could probably make 80% of the premiums while only waiting 50% of the period. So if that happens, then I will most likely take it out. So something I'm considering. All right. So if you have any questions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free trades. Thanks for watching.